thanking them because they have accepted.
Well, I didn't prepare anything on myself. I actually thought that I would just dive right into the topic of valuation and investment, but to at least give us just a little background, I went to, I used to study here at Rudbeck in the 80s. And then I moved to Stockholm to study at Stockholm School of Economics. I actually did it because I was tired of school, so I thought that reading economics could be a nice time off. And then in 1994, I had no idea exactly how it happened, but I got a job at a broker firm. I was never interested in finance or didn't have any clue of the differences between, for example, an analyst or a portfolio manager or a trader. But in 1994, I became an equity analyst, and thanks to my interest in IT, also knowing a little bit of coding, I became the IT analyst. Once again, just a complete happenstance because nobody wanted that small sector. You were supposed to cover healthcare or the big industrial companies like SKF or ABB. That was what was considered important. So I got the IT sector, which was quite fortunate because that made it very easy to make a career once the IT bubble started inflating. However, I was headhunted to Swedbank to run their IT analyst department in 1996. And then in 2000, I was growing completely disillusioned by the valuation levels at the stock market. I mean, I was supposed to give out buy recommendations, or at least as many buy recommendations as sell recommendations. And I was finding it more and more impossible to justify any kind of buy recommendations on IT stocks or internet stocks at the very peak in early 2000. So I was actually thinking about quitting the industry altogether because I couldn't see a future for me doing that type of almost dirty work for big banks. But fortunately, I was still very naive, had no idea of the real structure of the finance industry. I was completely myopic, just looking at reading annual reports, doing my valuations and recommendations in a very static and staccato way. No feeling at all, no true understanding of what I was doing. But despite that, I could see that everything was just too expensive. Anyway, so I was going to quit when a friend said, "Do you know about hedge funds?" No. And then he explained what they were and how you made money if you were at a hedge fund. And he had found this small startup that we both joined. The reason he asked me actually was that he knew, let's say, the 4 or 5 top-ranked IT analysts in Stockholm, and he wanted one of them to come with him to this new hedge fund. And he had heard that I might set up my own venture capitalist fund rather than just retiring from the industry. So he was afraid that I would pull ahead of him in terms of fortune. So he wanted to lock me in at the same place, which meant that we would still be equally rich once everything settled. So I could just as well have retired in 2000. Instead, I became a hedge fund manager, and the Futuris within the Brummer and Partners group where I began. It turned out exactly 10 years later to win the award European Hedge Fund of the Decade. So the best hedge fund in Europe out of several thousands over this complete 10-year span, which is just incredibly just fortunate. And it says something about our hard work, but it mainly says something about when somebody has to flip the coin correctly 10 times in a row, and that happened to be us. In any case, that career plus a short stint again, 3 years at Antelope Hedge Fund just recently, plus my private investments in about 20 different startups, it kind of entitles me to talk about investing in practice, which is completely different from portfolio theory and whatever they teach you here at school. I mean, I would really like this to be only like a conversation from now on, from right now. But I understand that will never happen, so I'll go through a couple of slides and see what happens. But I do encourage you to just jump in and ask anything, your own private portfolio, for example. Anyway, is value investing dead? That was the title of it all. And it kind of seems that way sometimes. There's just incredible momentum in the stock market, and especially for the largest tech companies. And it's difficult to justify their valuations by anything else than, well, they have this incredible position. But again, if they are too expensive, they are too expensive. And if you, like for example, when you buy a bond, you know that you will get 100 in payouts. A couple of years from now, you know that, and if you pay more than 101, you know that you will lose money. It's perfectly certain. Not counting deflation or lots of other like annoying details, but you know that if you buy it at 101, then you will lose money. Buy it at 99, you will make money. The same actually goes for equities. It's just that you don't know what the 100 is. There is an end value. There is a true value that is the sum of the cash flows that you sooner or later will get your hands on. And if you pay more than that, then you will lose money. Unless you happen to be able to sell to some bigger fool along the way, who in their turn hasn't really considered what the actual value is. Anyway, I definitely do not think value investing is dead. I think value investing is what investing is. On the other hand, I mean, it is buying an asset for less than it's worth. It's super simple. The problem is just to calculate what is it worth. What's important to always keep in mind is to not use too many different soft factors when considering value, but always thinking in terms of, if I take cash as a certain species and I lend it out to the market, I buy a stock, I mean, I part with my money. The only thing that the value calculation is based on is how much cash will I get back and when. You can make a lot of adjustments for risk level and other uncertainties, but in the end, if you pay 100, you want 110 back as quickly as possible, and then hopefully do it again. The tricky thing here still is, of course, to establish that value. And I'm sure they have taught you that discounted cash flow analysis is the correct way to value a stream of cash flows. It's definitely true. It is, as my professor at Handels, Stockholm School of Economics, told me, that it is the only theoretical way to establish that value. But on the other hand, it's just it is simply a theoretical value. It might be correct theoretically, but it has no robustness to it. And you can change around all the various parameters, and the formula in itself is so deceptively intuitive, and you think that, well, I just tweak this variable a little bit here and this one a little bit here, and then suddenly you can come up with exactly whatever value you want to. So it's more or less completely useless anyway. Instead, I go with a really, really big picture view of markets and what has happened over 100 years or 200 years. And for example, if you take a look at the U.S. stock market, the S&P 500, over about 100 years of history, actually 150, it always returns sooner or later to a valuation point, where the investor that buys at that point, at the average point, subsequently gets a 10% compound annual return. That seems to be what investors on average over long periods of time think is a fair payment for the risk and for parting with one's money. And this gives us a very nice shorthand to what value is. On the one hand, we know it's a discounted cash flow analysis, but we don't really know what would be the correct values to put in. But here we have one, and it's that if you use a 10% discount rate, then if you calculate the net present value that is the same as the share price today, then you will also get a 10% compound return in the going forward. In a way, it also makes sense. You should get at least 10%. I mean, if it's less, you could just as well just buy a bond, a corporate bond, and make between 5 and 10%. Or you could educate yourself, or you could start a company. There are many ways to earn a 10% return on whatever you invest. There's no reason to take risks on the market unless you will get at least 10%. And 10% is for the average stock, the average market, preferably with a lot of diversification. But no matter what the theory behind it is, even if it does make sense, it has practically been shown that the market valuation, it gets back to about price sales 1, and an average annual return when bought at that valuation level of 10% going forward. But then we have, here is a chart that in a way says that value investing might be dead. So it's a little difficult to read, but what it's basically is, it's a price sales measure for the US stock market. And in between 1947 and 2009, if you are a little bit willing to tweak whatever it's you perceive, then there is the average is about 1, and this is non-financial market capitalization through non-financial corporate gross value, blah blah blah. But what it really is price sales adjusted in a little bit fancy way, and it's with 100% insight. I mean, there's no uncertainties in this number. There are no forecasting being made here. So it has typically been price sales 1. That is what the market comes back to all the time. And if you bought at higher prices, like close to 1.5 or 2, then you got maybe 0 returns over 10-year period. And if you happen to buy it at the lowest valuations, then you typically got 20% per year for a decade, and then everything resets. But here it almost looks as if there is maybe from here and all the way up, like there's some kind of a trend going on, and not least starting here in 1981 and going forward. It's like, could this really be? Because what is a valuation? I mean, a valuation, it's a shorthand that says, if I have a stock that has a sales of 100, if they make 10% margins, then they have a profit of 10. What would that be worth to me? Well, one way to look at it is if I pay 100 and I make 10 in profit every year, that's 10%. That's a fair value. And then we're back at price sales 1 again. That would be kind of fair. You would get your 10% compensation. But when you pay 3 times sales, either you would have to expect much higher growth going forward than what has been the case in the last 100 years. And if anything, growth is slowing. Productivity from decade to decade, no matter what type of technologies we throw at humanity, productivity growth is slowing. Sure, you might say that, well, now with the recent bout of AI tools, maybe that it can accelerate again, but then again, you said that about all the other technologies as well. It's as if there's something inherent in society, in us as humans. We can't take that productivity. We will some ways adapt in a way that we will just keep growing about this as quickly as we have always done. So that population of 1 or 2% and productivity of 1 and 2%, and then inflation on top of that 1 to 2%. And if you take the absolute best companies as well, they grow another 1 to 2 percentage points faster than everything else. And that is what amounts to, in the end, that profits rise by about 8% per year, and you get a dividend of 2% on top of that. So that is what actually produces the 10% average returns, unless you have some kind of trending valuation. But the trending valuation, it doesn't make sense. Because in the end, somebody has to suffer paying for that high valuation. If you happen to be the last owner of a stock and you can't sell it to anybody, then all you get are the profits, and that might mean if you pay 3 times the typical valuation, then you only get a 3% return rather than a 10% return. But on the other hand, tell that to people who sold out somewhere along the way because it got too expensive, and valuations keep trending. And here is the problem for a value investor, that sometimes even for pretty long stretches of time, it's very difficult to find something that actually meets the requirements of a sound investment. But that doesn't mean that one has to play the game and participate, because it is speculation. If you don't buy at a price that's lower than the actual value. Here's another way of looking at it. It's more or less the same chart. It's a little bit longer, and instead of price sales, it's a kind of a price earnings estimate. Actually looking backward, so it's not no forecasting involved here either. And it's the blue line shows it's been scaled to fit with the subsequent is it 12? Yeah, here is it 12 years. Subsequent 12-year annualized returns for S&P 500, which means that if you think that these charts are reasonably well fit to each other, that means that in any point you look at, the valuation level had a forecast of how much S&P 500 would return every year for the coming 12 years. So, for example, if price sales was 3, then this model has an estimate that says that you will get about minus 7.5% per year for 12 years in total return from S&P 500. And it's worked like amazingly well, both in the very like crash bottoms and the market peaks. Except maybe there's something that kind of happens here in the last during the quantitative easing era and money printing era. Suddenly it's much more common with large discrepancies between the red and the blue line. So maybe, to get back to the original question, maybe quantitative easing and too much debt and more and more desperate attempts by politicians, maybe they have actually managed to kill value investing, at least from a total perspective of the stock market. And on top of that, there's another parallel development where passive investing, and that is just algorithms that either just try to find trends and momentum, or simply mimic an index that they blindly buy and sell, mostly buy, because there's a lot of automatic money coming into the pension system and for other reasons. And not least also from quantitative easing. Because when you create a lot of base money, then if everybody still wants the same proportions of their various assets, including stocks and cash, then they have to buy more stocks. The stock prices, the total value of stocks has to increase to make the proportions between assets classes to keep it constant. And that means that there is a lot of money during the last 15 years that doesn't care at all about valuations. Like, for me, it's so strange that there are trillions and trillions, tens of trillions actually, of money out there they couldn't care less if they pay price sales 1 or 10 or 50. They only buy it because it has a certain weight in the index. There's a rule. And there seems to be a slowly accelerating trend of this passive index investing creating a smaller and smaller actual free float, which means that in order to actually get to your targeted index weight, you have to buy stocks in certain volumes that make you keep chasing this target weight, and you can never get there. So there is a constant melt-up in admittedly quite violent cycles, as we've seen in between 2018 and now, with there was more or less a market crash in the fall of 2018, and then we had the COVID 2020 and the market crash also of the early 2022, which amazingly was the fastest share price drop for the index since 1929, if not ever, in that first half year. A little bit of like date mysticism about that, but anyway, it goes to say that there really was a market crash in 2022, which now is completely forgotten. We're very close to all-time highs in most indices again, and valuations are higher than they have been throughout history. Maybe rivaled slightly by December 2021, but otherwise, if people thought it was crazy on the top of 1929 or crazy in 2007, it's way worse now, and that is while we have the geopolitical situation that we have interest rates that have been increased by 5%, and sure, productivity might accelerate or not, but there is no hard evidence for it. And there's no reason to believe that this process would stop either. Actually, the best bet you can typically do in investing is that whatever you're seeing now, that will keep happening. And this melt up for the Magnificent Seven, the 7 largest tech stocks, and this index effect of passive flows, it's probably what we'll keep seeing in the coming years. And one reason is, of course, that almost no money at all cares about valuations. There's no factor limiting the development. There are no large, like short-biased hedge funds or value investors that can go short or dare to go short. There are a few prominent like hedge fund guys, but they've mainly given up. And actually, my 3 years at Antelope Hedge Fund, they came about because my girlfriend asked, like, Mike, you're losing so much money being short the market. There must be a better way to not like stocks. Like, shouldn't you be able to own something else instead of like going short the market? And then in the end, she devised a strategy of tactical asset allocation between gold, soft commodities, and stocks. And once she and an old colleague of mine, Martin, had set up the structure, they said that we might need somebody who actually knows stocks as well. So perhaps you could come out of retirement and sit with us. That is so. I am one of the victims that realized quite belatedly, unfortunately, that shorting a stock market because it's expensive, or because you see a recession around the corner, or you see that there are like negative developments going on, it simply isn't enough at all compared to the automatic flows and this index weighting dynamic that is completely valuation agnostic. The reason value investing works, the reason anything gets too cheap or too expensive, is that cheap can always get even cheaper, and expensive can get even more expensive. The market is always trending. It's not really looking for an equilibrium. As you can tell from the first charts here, I mean, valuation-wise, it's fantastic that the entire stock market can go from 0.45 price sales and up to like 3.6. Okay, it hasn't quite been at 3.6, but like it's almost a ninefold increase in valuation. Like not that the stock indexes have been up 9 times. I mean, that wouldn't be strange at all as long as profits or sales go with it. But the market, like, it's truly mano-depressive. There's no theoretical basis for why you would pay just 0.45 price sales for the entire stock market, or for that matter 3.5. And yet we end up there just because everything keeps happening incrementally, just a little step every day, and nobody really cares about valuation. Anyway, the way I think this will unfold is that I definitely think that value investing still works. I think there is tremendous value in Standard & Poor's 500 and also for OMX. But in order to capture that value, you would have to dare not invest in the Mag 7. But that also means that, like, for example, this year, the Mag 7s, they are up like by 50% or so. And if you missed out on that, you might actually be down on every other stock. And that's like a career-ending decision, which is pretty weird, because how can you actually judge investments based on just 1 year or 2 years of performance when we know from the beginning that the reason that value investing is supposed to work is exactly because it doesn't work in the short term. Otherwise, we would never get bargains, or it wouldn't become expensive either. So we do find ourselves in a like a bit of a bind here, where I definitely am completely sure that value investing works, but then again, works how? Maybe it doesn't work for a portfolio manager, because if you are a portfolio manager, then what you have to consider is your career, not really what returns you give to your clients. Luckily, I'm not involved anymore, so I can say that. Anyway, my approach to value investing, it entails like a very simple big picture analysis of it, 2 trends. I simply just analyze the price in terms of the factors fundamentals and valuation of that fundamental. So, for example, sales and price sales, or earnings and price earnings, and there are patterns in the fundamentals. So, to make it concrete, you just take the annual report and you look at the income statement and balance sheet and cash flow analysis, and then you can start extrapolating like line by line, more or less intelligently. Either you just go by the guidance, like they say, we're going to grow by 15% per year and we're going to have this profitability, or you actually take a look at what they have actually performed, or perhaps even better yet, you check what similar companies in a similar situation have managed to do before. So you actually have a kind of already a template. You can see what Cisco did in the 80s and 90s, for example, and then perhaps model how Facebook or Alphabet will how their growth trajectory, what it most likely will look like. Anyway, so this doesn't mean you have a money machine at your hands, but at least it means that you can do just a slightly better guesses, and not least knowing what it is that you are guessing. So you have like a sales of 100 today. You know how you got there. You can see the patterns for that company up until now. What created that growth, and what is then the likely growth trajectory going forward. And then you do the same actually with valuations. And here it, of course, becomes even more tricky, because if you have a company that has tended to be valued at like 75 times earnings historically, you can't just blindly assume that it will keep being valued at 75. On the other hand, what you can do is that you imagine yourself 4 years into the future. You're standing there, and then you have your fundamentals forecast. So you know what kind of history you are looking back to 4 years into the future. And given that information that you are responsible for, then you can take a guess of how the market will likely value that stock in the future, because you already know how the market values similar companies today. So you can see that if it has grown by 25% per year in the coming 4 years, then it most likely will be like valued at maybe 35 times earnings or something. But if it has stagnated, then you can be pretty sure that it will be lower than 15 times earnings. The good thing is that we have a lot of we already have the results for all the other companies today. So as long as we can make a reasonable fundamental forecast, then it becomes at least easier to guess what a warranted valuation level would be in the future. You can never know. Maybe they have a crazy genius CEO or something, and that can keep pumping up the stock price. But in the end, that is not anything that we can. Yeah, sure.
I have a question based on the choice of stock in portfolio. So based only on the information that is given by the market, or other information that you have to consider this?
Well, in my own private portfolio, for the one hand, I have more than 80% of my investments in private equity, so nothing public. And the few stocks that I actually do have that are publicly listed, they are typically junior mining stocks, pre-revenue. I do have pretty tight connections with the main shareholders and like management in those companies, but that doesn't mean that I have access to any non-publicly available information, but perhaps I do have a better understanding of what that publicly available information actually means. Because if you just read the press releases of a company, it's very difficult to put that into the actual context, especially if you haven't been like on a board of a company, for example, or run a company. Then it's just like, how do you think that press release gets made? When the board has to like craft it, they have to abide by certain kind of rules and regulations, and in the end, it's a marketing effort. It's always a marketing effort. But if you actually are on speaking terms with the ones running the company, you have at least the potential to understand it better. The problem with that is that psychologically, then we just tend to get attached to the company instead, and it becomes all the way easier to fool yourself into thinking that I'm on the inside here, so I'm going to tough it out. So it is tricky. It's difficult. Anyway, so this P equals F times V, for example, the sales and price sales. Here you have the discretionary opportunity to take recent valuation trends into account. Even if I say that the average company, it should be valued at price sales 1 or PE 15, and that's where everything will end up, given we go far enough into the future. Right here and right now, a certain type of index of subsectors might be chronically valued at higher multiples, because they are considered hot, or there's a trend towards climate investments or AI investments. And that means that you can, rather than just assuming the correct DCF, normalized DCF valuation, which is like, if you set up a standard DCF, just puts in the numbers of an average company, then you will get that the DCF will give you the result of price sales 1 and PE 15 is what is warranted, unless you use very optimistic discount rates. But on the other hand, you don't have to use that theoretically correct valuation multiple of, let's say, 15 times earnings. If you know that this sector and similar companies, they tend to be valued at 25 these days, or you dare draw some kind of conclusion of this like valuation valuation trends. Maybe not that valuations, they don't have to trend upward, but at least you can maybe notice that if I didn't look at all the history here, then maybe I would say that, well, in modern times and with modern monetary policy, then perhaps it's rather 2 times sales. That is where we will probably stick around for some time until there is a phase change, until something quite different happens. It is still speculation, because if you pay price sales 2 and you can't expect either higher margins than average or much higher growth, then in the end somebody loses money. And so far, every time we've gotten to these valuation levels, there has been a real market correction, a really hurtful one. But on the other hand, that's where you really make money, because when the entire market falls by 50%, then there are stocks that fall completely out of favor and becomes extremely cheap. And you don't have to really go for the FANG stocks. Okay, so that is P equals F times V, and here's the simple way of showing P equals F times V, and this actually is the simplest way I can put my idea of value investing and valuation of a company, and it's made to look busy, but all it says is that if you have some kind of a fundamental variable today, and what are fundamental variables? I mean, it's earnings, sales, equity, assets, cash flow, and maybe return on equity. So it's like actual accounting data, the actual money that they are making. That is what is the fundamentals. And then there's always a valuation multiple, like how many years of earnings, how many years of sales, how many percent of the equity value, the book equity, well, you could turn that around and calculate the cash flow yield instead, CF through P, and of course all the other multiples you can think of. And from here, it's just a question of making a more or less educated guess in what will happen in the coming 4 years. And you have a set of standard analytical methods. For example, like you have the growth rate, of course. Like you check the history for sales. I mean, if it's grown by 10% every year for 20 years, what would you guess next year is? Well, 10%. But on the other hand, if you dwell a little bit deeper, and maybe you find that they keep launching new products, but this time they won't. Okay, then maybe growth won't be 10%, or perhaps you have like the rate of change is that growth has been 10%, 9%, 8%, 7%. Well, what would you guess the next number in the series would be? Like maybe 6 or 5%. That could be a good guess. And then you just keep doing this, and going deeper and deeper, and thinking about, okay, but what is the difference between this year and all the other years? Is there anything else I can do to make an even better forecast? And if you're a sell-side analyst, you will end up with models with thousands of lines just for estimating sales and margins, and that is not a good way of doing it. If you find yourself doing things like that, then you have to take a step back and think about, like, what is my contribution here? How can what I'm doing here and now, how can that actually contribute to better investments? Is it really plausible that if I add another line trying to estimate like exactly how many iPhones Apple sells in every country, and then making guesses of what their actual margins in every country is and so on, and that would typically not make a better forecast than just make like if I spend like 5 minutes on any big company and just looking at what their sales trajectory has been historically, then I don't really need to know anything about their product launches or anything. There is a pretty smooth development from quarter to quarter where you can make it quite easily guess what next quarter will be, and also next year. And then on top of that, you have their guidance, because they don't want people to be surprised. So making forecasts for these fundamental variables, that's not very hard. And then there is a valuation multiple. I mean, you have the historical range for that very company. Like if it's always traded between 12 and 18, then you can. It's a pretty good guess that it will stay between 12 and 18. And you have the peer range, like what are other companies that look like this company, that has the same characteristics, where are they being valued? Because this is what happens, at least for certain types of investors, that they keep ranking and comparing and trying to find the cheapest alternative within a certain niche. And then you have like what I would call an absolute range, which is the theoretical value. Like even if you have an historical range of price earnings multiples between like 15 and 20, there is also an absolute range which can be determined by as a standardized discounted cash flow model. If you put in the growth rates and profit margins, you'll end up with a certain type of warranted value. Once again, the problem is the discount rate and the growth rate. And all the other actual, all the parameters of the DCF model. So, well, you can tell I'm not really a fan of DCF analysis. It's the best way of fooling oneself. Fortunately for me, though, when I was this naive IT analyst in the mid-90s, I thought, I still thought that DCF is the only correct way. And I just took the lofty ambitions of the IT companies, I put it into my models, and I said that these should go up by several 100%. And my colleagues, which were used to looking at Atlas Copco and SKF and have target prices of about 10% above current value. And I was like, no, 200%. And just being naive that way and using DCF models, that's really what propelled my career. So being really stupid and naive, that made my name as an IT analyst, which in the end put me at the hedge fund. Fortunately, by then I had matured, and that's also exactly what put me there, because I was going to quit the industry in 2000 just because I thought everything is too expensive now. I can't work this way. And I had no view of what valuation really meant back then, or I couldn't have put it in terms like this. There is a simple way of just breaking numbers a little bit down to their components. I think we'll skip that. Here's just a couple of interesting data points on the Magnificent Seven. This one just shows that once you've grown quickly, you tend to grow a little less quickly. Yeah?
I have a question related to the previous slides, because this one, because I see there a lot of work to do, and it brings me to the question that I get often from students or what is the optimal number of assets in your portfolio? Because if you are doing this on one, we have thousands in the market. How many are going to be to choose?
I don't think it's time well spent to try to go through every stock or try to find systematically find the very, very best investment. I think good enough is good enough, and luckily as a professional analyst, I've had to go through hundreds of companies. So I have a short list of companies that I understand, and which means that I can focus my time on the same old companies again and again. And every now and then there is somebody who really wants to pitch a company to me that I don't know anything about. And usually I'm pretty reluctant. I think that I have enough of companies to choose from. But then sometimes every now and then there is something that sounds like this is really, really interesting. And that goes for example for my entire portfolio of listed stocks now, all these junior mining companies. I think that they have there's a super opportunity for junior miners in gold, in uranium, in all these battery metals and anything that goes into the coming wave of electrification. And up until, I don't know, 5 years ago, I wouldn't have touched any of these. But I kind of see that the tide is changing in the whole of Europe and not least Sweden in terms of mining. If they're here's more of a complete guesswork, but after a couple of decades of focus on intangibles of software companies, of social media, of ad sales, then I think we could pivot a bit more into the world of atoms, and that everything that we're supposed to do here in terms of solar cells and windmills and whatever have you, it has to be built from the actual stuff. And if we use wind and solar, we also have to have storage for the energy. And that means a lot of batteries or other types of solutions. That also takes a lot of material. And if we don't do it that way, then we have to have some kind of a base load in energy, and that the only thing we really have is nuclear. My whole investment portfolio is simply built around the energy needs of the future. I think I only have 5 stocks. It's a little bit on the low end because you have to have room for bad luck. If you have bad luck in just 1 or 2 stocks, then that's a pretty tough hit for your portfolio. I would typically recommend maybe between 7 and 17 stocks, perhaps, or assets. Yeah, sure.
When you say you have 5 stocks, do you mean you have 5 stocks and other assets, or do you mean you have
everything in 5 I only have 5 equities in my listed portfolio. But then again, I have like 10 stocks, 10 unlisted companies, which is the bulk of my portfolio. My diversification is much better than what those 5.
So for an average investor, what do you recommend? Like around 7 to 17, you said?
Yeah, and I would say like around 10 is a good number. I know many people think that it should be more, but the way I see it, I'm going to get to you soon, is that if you have 10 stocks, the one the absolute best, just intuitively, maybe it should have at least twice the weight of like the average. So maybe 20%. You've invested a lot of time and resources, and you've got this one really good idea. Then perhaps 20% of your portfolio in that stock, and then just a linear downward slope for all the other investments, and the 10th stock should be like half of the typical weight, so maybe 5%. So you have from 20% to 5%. And then let's say you want to add an 11th stock. This is the stock that you know the least about. And you've already spent a lot of time on the other 10. And now you're trying to add an 11th stock. And since it's the one you know least about, it has to be the smallest one, which is maximum 4%, I would say. So you only invest like 4% of your portfolio in this 11th stock. And you know the least about it. So what can your like profit expectations be? Probably not that high. And if they are high, then it's because it's a lottery ticket and you really don't know what you're doing. So is that a good way to invest your money? Probably not. So that leaves us with the scenario that you have just 4% invested in the stock that you know the 11th most about. I can't really see how that would add value to your portfolio. I know it does up until about 15 stocks in terms of like general diversification. But general diversification is built on the idea that you don't know anything at all about the stocks. It's just blind diversification. And it works if they are not that correlated, and it kind of captures the possibility of luck or bad luck. But that's not how you're supposed to do your investment as a value investor. You're supposed to put in the effort, you understand the company, and it's supposed to add value to your portfolio. But at just 4%, it really doesn't, especially since it's the one you know the least about and could expect the least from. Unfortunately, he was before.
What platform are you using?
When I analyze stocks, typically Koifin, it's a free online resource. There's a freemium model. You can pay like $20 a month if you want slightly more data, and that's actually what I've been using at Antelope. Before that, I had a Bloomberg terminal at Futuris, but I really didn't think it added any value whatsoever. I think that the big picture analysis that I make, it's really almost back of the envelope calculations. Like here's sales. How do the sales progress in the coming 4 years? And what can I expect from profit margins? What does that mean 4 years from now? Well, it means this profit, this sales, and what's my best guess at how the market will value that at that point in the future? And what does that in turn mean for my annual compound average growth rate up until then? So I never try to calculate a net present value per today, but rather I try to calculate the likely annual returns. Because there's no basis for me to say that, well, this stock is 100% undervalued, so therefore instead of 15 kroner it should be 30 kroner today. But what can I use that for? I mean, it's definitely not going to just magically suddenly jump to 30 just because I came up with that idea. But it's more reasonable to think that, okay, you have understood something about this company and its profits and likely valuation, and perhaps the market will also realize this over the coming 4 years, slowly, surely. All right.
I have two questions. So the first one is the number of stocks in your portfolio. Are you talking about your personal portfolio or the hedge fund portfolio?
Yeah, well, my personal, and in both Antelope and Futuris. At Futuris, we had about 40 stocks in total, and we were 4 managers. So I was responsible for about 10 of those 40 stocks. But then again, it's the portfolio that counts, so 40 stocks. And at Antelope, I actually had about 40 stocks, since I was the sole manager running the long-short equity part of the fund. But now I've quit, so Antelope is changing direction, and I'm happily retired again, more or less starting today. But I did have 40 stocks, of which about 15 to 20 long and 20 to 25 short. I typically sized my short positions smaller than the long positions. And my mandate was also always market neutral, so no actual net market exposure. Then maybe you wonder, but how can you have like 40 stocks in your hedge fund portfolio, but you only recommend 10 in your personal, and you only have 5? It's because clients aren't that risk tolerant. It's simply an adaptation to the industry. I would happily have just like 10 stocks in the Antelope portfolio, but it's simply not. It's just not doable from a marketing perspective, even if I think it's correct. Okay. One more.
Yeah, one more question. Right.
I got you.
I can see that you are a value investor, right?
Mm-hmm.
Okay. But even if you apply all those ratios to analyze company to determine the value of company, there's still the possibility that the price of the company can continue to go down, just like you said that what goes down can continue to go down. So what kind of risk management strategy do you have in place to quickly cut your losses in order to do you have risk management?
Yeah, well, since I'm fully aware that I don't know everything, and even if I look at the numbers and I have my forecasts and I think that, well, there's still very good value here, and it doesn't really matter if the stock price keeps falling as long as profits are developing the way they should. Like, I don't care if the oil company that I own, if the stock keeps falling, but the profits stay high. I mean, then I would keep owning it because I will get that as dividends, or sooner or later some kind of a takeover. So I will get the money. If it's a sound investment, it's a sound investment. But on the other hand, if the stock price keeps falling and I can't know for sure that I have control of the forecasts and actual deliverance, then I typically did take stop losses, just because it's not worth it. It's not worth trying to explain why I stick to losing positions. But that said, I've always had quite a high threshold of tolerance for losses. For example, in 2013, we had these rolling European crises all the time, banking crises. And I saw the huge problems with bank balance sheets in 2010, 11, 12, and 13. And in 2013, the market took like a real nosedive, especially banks. And I was short banks at that time, which meant that I kind of saved the entire portfolio for a couple of months. But then it turned. Mario Draghi made sure that he will do whatever it takes. They tried to compress the yield spreads between various more or less bankrupt European countries and the other countries like Finland and Germany. And that fall, my part only in the portfolio lost 1 billion kronor. 1 billion. I was simply too slow to take the losses there. I mean, I should have taken a stop loss just because I didn't know what was going on. I mean, I had my analysis. I mean, I know exactly why I did what I did. I know why I stuck to the position. And I thought that you can't just paper over losses like this. I mean, the losses are there. But what I didn't realize was that the market, it really didn't care, and it knew that the system will be saved one way or another, and central bankers will make sure that the banks can print enough money to themselves in terms of margin spreads, and make up for that they actually have these huge holes in the balance sheet. I thought that, well, here and now you are bankrupt. You are bankrupt according to all the previous legislation. But central bankers said, you don't have to really say it out loud that you have these holes. Just wait for a while, and it will all be over soon. So you have to be open for, even if you kind of are right, that the stock market is telling you something. There is like a herd mentality or a flow that you have to take seriously. But I've always find it difficult to talk about stop losses. In the early times, whenever I met clients at Futuris, I said, why would we use a stop loss? I mean, either we make good investments or not. And if we have lost money on a position up until now, why would that matter? And I've also it probably took me 10 years in the, well, maybe not 10, but 5, 6, 7 in the public arena before I realized what this GAV stood for. In a hedge fund business, it means gross asset value. It's what the portfolio is worth. But after a long time, I realized that people were talking about what their average cost of buying the shares in their portfolio was. Like, so why do you care if you paid 200 for SKF or 150 or 200? How does that influence your decision today? But apparently that was what people were talking about all the time. And if you said that, yeah, well, I have these stocks, well, like, oh, so what's your GAV? What did you buy it for? But like, yeah, I never could understand why that mattered. And the same thing goes with stop losses. Like, if you either you like the stock today, here and now, or you don't. But then, of course, when you have to talk about when you take clients into consideration, and then they might have something to say about it. So it becomes a career risk, and therefore you have to have a stop loss procedure in place that you can actually talk about. But whenever I've heard anybody talk about their stop loss procedures, it just sounds like, okay, so you lose 5% and then you take the stop loss, and then what? Like, which stock are you going to buy then? I mean, it was your best idea then. So like, how long will you take a pause? Like 1 day, 2 days, 3 days, and then buy it again because it still turns up as your best idea. So the whole notion of stop losses, it's weird. Either you make a good research or not. That said, however, if the stock price keeps falling, there might be some information you don't know about. So you could take that into consideration and realize that, well, there are uncertainties here that you could just as well take one of the other 100 stocks that you like. And in my private portfolio, there is no such thing as stop loss. But I've had about 10 bankruptcies, so 100% loss. But on the other hand, I've had a couple of 100xers, so it makes up for it. Let's see now. Well, here are some things that maybe some of these. Like I once got the question what I had to unlearn from school and from my early days, and one of the more salient one is this, what I call equilibrium versus pendulum, and is that markets do not at all tend towards equilibrium. There is no function that makes the markets try to go to the actual correct valuation. It's all about flows, and like if you see the entire market or financial marketplace as a like a flat bowl of water that's sloshing around, and once you tip it to one side, then the water flows to that particular point, and it becomes overvalued, and something here gets completely dried out and undervalued, and there is really no natural way for it to stop in the middle, because you will always, the market on average will be lured to the hot trending stuff. So they will become overvalued, and the market, the entire market in itself is the same way. Once the market finds a really positive and strong trend, that it pulls money in, people will take on debt. They will save more in order to buy more stocks because they see the potential to get rich, and you buy what works. And if you don't buy what works, then you're going to get obsolete and fall behind anyway. So the ones buying what works, they are the ones who also will make it, at least short term. So this is a kind of procyclical behavior that makes markets like truly hate equilibrium. The short time that the market is actually fairly valued, that's typically when prices are moving the fastest away from that equilibrium. And maybe I should add here what I alluded to earlier, and that's there really isn't anybody caring about valuation anymore. You can hear people in the news talk about things like that stock went up because of that, and the valuation is here and here, and but in real life, it's just like it's all based on flow, not on actual valuation levels. It's about how much money is like slowly or quickly flowing into certain areas, and that money does not care at all what the actual valuation or the return prospects are. They just do whatever everybody else is doing. That's a completely different way of functioning than I could have ever have imagined that the market that it actually worked that way. So I'm just happy I survived the first, like my first decade in the market, from being that like naive value-oriented person that I thought that actually if you buy something that's cheap, you will pretty soon make money, and if you short anything that's expensive, the market will reward you pretty quickly. And it's just was lucky that I happened to be active in a period where that actually worked within just a couple of years each time. Unfortunately, every 2 or 3 years or so, I also was struck by hubris, thinking that, well, everything you touch turns to gold anyway, so why even put in any work? You can just go by intuition, and then typically some kind of disaster struck always, because I got too greedy and full of myself. But then again, I had luck being active in the market where actually if you made your research thoroughly and bought cheaply, you actually did make money. And if you sold expensively, then you've made money within a couple of years. But it hasn't really been like that for the last almost 10 years. Let's see if there's anything here worth talking about. Well, there's a lot of stupid stuff about brokers. Like, for example, when I was a sell-side analyst, I thought that my job was to make an objective assessment of the company and its shares and issue a recommendation, a heartfelt recommendation. This is a good buy. I really think that my clients should buy this stock or sell it. I just couldn't understand that you are not supposed to have sell recommendations, because that means that your client, your company gets less business from that company. So the M&A department and the lending department in the bank, they all will get like angry calls from the companies like that. Well, what the fuck is going on? Why does your analyst have a sell recommendation? Pull his leash. So and I was once like almost like taken to the principal's office, but the head manager of Ruber, which is Sweden's largest asset manager, and they really grilled me for like why do you do this? Why have you done this? Like, we are your number one client, and you're doing this to like, you're making this comparison. You can't drag us into like this. And I was like, but it's true. So never go with the truth. Actually, once my colleague said, like, so what did you do? And this was in a relationship issue. I was like, well, I thought I'd just put the cards on the table to my girlfriend and just tell her the way it was. And he was like, no cards on the table, no cards, absolutely no cards on the table. And it kind of holds very true for the entire finance industry as well. Like, it's all about narratives, it's all about appearances, it's about client relationships. It's not about truth. But the truth, on the other hand, that's something you can use for your own private portfolio, or maybe as a hedge fund manager. Because what I at least the way I experienced it was that finally I have nobody to answer to. I am the client, so I can do exactly whatever I want as long as I keep performing. And that was if there's anything I can recommend if you're interested in like a finance career, is to get to the sell side as quickly as possible. You do not want to be at the buy side. It's like it's almost like being in a serf or some kind of almost a slave. It's not worthy. Like, let's keep that. I think I'll list. I can finish off with this, and it's after my 15 years at Futuris, I wrote a kind of a book, 150 pages, where I went through the 69 most important decisions we made over those 15 years, and it became like 50 rules, 50 lessons. And those 50 lessons I distilled into these 12 like traits that are actually just as good for life as it is for investment. It's what type of traits you should foster in yourself, of which one, the most important one, all like hands down, is patience. The reason value investing works is because it doesn't work. So you have to be patient enough to wait it out. You have to be patient enough to research the companies for real. I mean, you can't just think there are shortcuts. Like, if you're gonna make money, you have to work for it. Otherwise, it's just luck and speculation. Once you've done the work and done the investing, then you have to have the patience to wait for everybody else to understand it as well. You have to be prepared to wait for like 4, 5, 6 years. I think typically you say it takes about 4 years for valuations to normalize and for the stock market to actually see what's happening, unless it's like super popular stocks that everybody is looking at. And apart from patience, I would like to stress self-analysis as well. That's where the hubris part comes in. Like what you need to do at all times is write down why you actually did something. Like, you have to have an investment diary which says, I buy Evolution because I think these things will happen. And then you can look back at those notes and at your performance, and you can see, did I make money? And was it because of these things that I said? Was it luck, or was it actually a skill, or was I lazy, and how can I then, in the next round, how can I adapt, not least my note-taking procedure? Like, how do I take notes? Because the first time you do this, when you look at your notes, it's like, what? I can't use this. typically also when you hear an amateur pitch a stock to somebody else, it's like it's a very fine company. Like, what am I going to do with that? Like, what fine company? Like, how much is it growing, and what's the return on invested capital, and when can I get my money back? I don't want to know if it's fine or have a good position. You can use that as kind of a backup for why you have the forecast you have. But apart from that, I can hardly care what industry a company is involved in. Of course, you have to know the industry as well if you're going to make good forecasts. But really, if somebody is pitching me an idea, I only want to know the numbers and the valuation and the risk of missing those forecasts. But by the way, did I forget a question from somebody? Yeah, you, sir.
No, I was just going to ask about diversification. Like, now in your personal portfolio, like, how do you diversify between sectors? Like, how much is the maximum amount of percentage of one stock, or like several amount of stock being one sector? And what was it in the hedge funds?
In Futuris, where I was for 15 years, there were no limits to how much I could put in just one sector. And often I just had one or two favorite sectors at any one time. So I typically had about half or up to 80% in one sector. But then again, we were 4 managers, so even if I had like 100% in one sector, then that would still only be like 25% of the portfolio. It's a pretty concentrated strategy, I would say. But we had other like colleagues in Norway who said that, like, if you don't have 20% in a stock or in a sector, then like, what are you even doing here? I mean, it doesn't make any difference. Unfortunately, well, he made a fortune, and then he lost a fortune, and then he shot himself. So if you've seen Exit, it's I have my guesses it's him. We happened to grab a beer together just a week before. Unfortunately, not the only person who shot himself in the head after a meeting with me. Don't do anything stupid when you leave here. And in terms of diversification in my own private portfolio, I think my diversification, it is all the unlisted stocks, the non-publicly traded stocks. I mean, it's still 10 different, completely different companies, and of which one is also a portfolio company, like an investment company that invests in businesses in the northern part of Sweden. So it's diversified in itself. It's like my exposure to Sweden. So that means that my listed stocks, they really are some kind of a lottery tickets. I definitely believe a lot in them, but it's not advisable to make your entire investment portfolio out of just 5 junior mining stocks, even if it's uranium, gold, and other metals. It is kind of diversified, but still, it's also mining. Mining can be out of favor, and there's political risk. Okay, sorry.
Yes, just to clarify something, when you say average investor should have 7 to 17, do you mean like average portfolio manager or average person?
Person. And I also think that there's professional portfolio managers. They have to think in terms of career risk and clients and authorities. And also monthly returns and quarterly returns, whereas a private investor can be much more long-term, because you don't have to present your results to anybody but yourself. And that means that you actually can buy things that are extremely concentrated or very long-term in terms of investments. You don't have to have like Evolution or the FANG stocks just to be part of the crowd, part of the investment crowd. And I think that just that private people have the opportunity to be long-term, that is a kind of free lunch. But it also comes with the problem that when you buy cheap stuff, it tends to get cheaper. And there's also often a reason why it is cheap to begin with, because there's been a lot of other people there before you. So in a way, the market is kind of efficient, and at the same time, it's highly inefficient, because you can tell from just take any stock. Like take Amazon around year 2000. It went from 100 to 5. So people typically say like how much money would I have had if I had bought Amazon back in 99, 2000? Like, I would have like 20 times. No, you would have sold at minus 95% and never looked at that stock again. And there are hundreds of examples like that shows the market is not efficient at all. It doesn't know what it's doing. It has no idea of how to value stocks. At least it doesn't value stocks. That's not what it's doing. It's a temperature of flow, not of the actual valuation.
Yeah, just one thing. So do we consider like anyone who invests an investor? So for example, I have friends who are investing, okay, but I would never recommend them to get like 7 to 17 stocks, as they do not have time to research, and also they're working like 9 to 5. So if I like give advice, you can get up to 17 stocks, they need to do the research. They need to know what are they actually buying, and that can cause some problems.
Yeah, and they probably shouldn't. They should buy Avanza Zero, Avanza Global, or Investor.
So I would say for average investors, it might be safer or less risky to just get funds and be satisfied with 10%.
Yeah, or maybe you could invest 90% in Avanza Zero or Investor or something like that, and take the last 10% in just one stock that you actually understand or have gotten a reasonably good advice in, and start from there, and then add one more and one more.
Yeah, or for example, you were talking about energy, that you're interested in like investing in this part, like mining. So instead of risking and finding the right company, you can just invest in some fund that follows everything. And an average investor who believes in that can get the percentage like that they're interested in, but yeah, they are not taking that much risk, so they cannot expect higher profit.
No, exactly. And most people really shouldn't try to invest in single stocks. But it takes a lot of time to really understand what you're doing, and what you're aiming is to add value to your portfolio. And how can you even believe that you will actually add value compared to all the like thousands and thousands of professionals who do this for a living? There isn't much logic to what most people do with their private portfolios. They do it for fun, they say. But what fun is it to be reckless with your money? Okay, sorry. I think you were actually. So.
Do you have any advice on how to avoid value traps? Sometimes you see the numbers and it feels super cheap. Then you have some other factors pulling the company down.
Yeah, well, maybe to wait until you have some kind of a trend with you. Like there is a reason you shouldn't shouldn't catch falling knives, because you have no idea why is everybody selling? Why are they getting out? I mean, they are the ones who actually owned the stock before, and now they're just dumping them. That doesn't mean that it's not cheap, but I would try to refrain myself from buying cheap stuff until the trend has turned up. Like better that the stock has gone above its 200-day moving average, or at least gone up for like maybe made a couple of increasingly higher bottoms over a couple of months period, just to make sure that the relentless selling is over. But then you still can't control, of course, that there might be something wrong with the business model, so that they actually don't make money. That's a much harder thing to establish. But for example, in the oil industry, you could buy these like super well-run companies at like 6 times earnings, and you know that there is a deficit of oil. It will keep being a deficit of oil. We don't really find any more oil, but we use more oil every year. So there's like, forget about like scaling down the oil consumption. It's going up. And still, these like almost monopoly companies can trade at like, okay, now they're up at like maybe 9 times earnings, but it's still extremely cheap considering that they form the bedrock of the economy. Okay, you first.
So you as IT analyst, what do you think about AI investing and its effect in the stock market?
I think most stocks are probably overhyped. They're a bit too expensive. I'm not really sure about Nvidia actually. I didn't make a valuation example where I said that it's not even expensive at 600 given certain assumptions. But otherwise, I think this is a typical example of a procyclical hype where the stocks are going up, it attracts more capital, they get more and more like airtime, which means that a lot of other companies think that we need to invest in this technologies. They keep buying chips from Nvidia, which means that they can have such enormous margins on the chips. I mean, they could just double the price. People would buy them anyway in this point of the cycle. But typically, you don't make that much money in the chip industry. So I expect that, for example, Nvidia, they will start. Maybe it takes 2 years, maybe 3 years until people are reasonably caught up, and they will still make a lot of money, just not growing at the current pace, and therefore it will be difficult to. Well, I actually think that here at about 500, it's reasonably valued, so it's probably still a pretty good investment. But in terms of all the other stocks, I can't really see how any of them will have that much of a competitive advantage. But if I were to invest in the space, I think I would go with the Magnificent Seven, all of them, because they are the beneficiaries of the technology. Microsoft puts AI into everything they do, which means that they will become more efficient in selling, in producing, in managing clients, in managing margins. And they're not really that expensive, and you can almost bank on that they will buy the companies that they need to buy. So they and Alphabet and Amazon and Meta, they will accumulate and concentrate all the important efforts within AI. Sorry to see. I think maybe you were.
I don't know actually. If I was first, but if one would like to invest in the AI hype, do you think it would be better to maybe invest in data center stocks instead of AIs?
I think it's a safer way to make money, but it won't be explosive. No. They're still just like real estate companies, almost.
Yeah. So I have two questions. So I'm not trying to break into your strategy with this. But what I'm trying to ask is that my experience showed that most successful value investor or value investment firm usually have a way of obtaining information from companies before the information gets to the public, like a company launching new products or innovation going on in the company. So what I was trying to ask is that do you have a method of obtaining those information before it gets to the public?
No, not at all. I am like, it doesn't matter if I've been a sell-side analyst or a hedge fund manager or private investor. I approach investing from a very big picture, intuitive way. Very little mathematics, very little trying to anticipate things or find information that nobody else has. I kind of count on that I will not have important or useful information anyway. So all I try to do is buy things that are out of favor, temporarily out of favor, because there has been a rotation out from maybe one sector into another sector, or maybe some temporary problems in a company. So I'm very much a proponent of reversion to the mean analysis. Like, there is nothing really new here. There will not be anything new going forward. And a stock that's been around for a while, like Ericsson, for example, I mean, it has been completely out of favor for a while. But looking back at like 25, 30 years of history, they tend to produce the same cash flow again and again and again. Sure, with a little bit of a cycle, quite a big cycle. But when you can identify patterns like that for a company, then whenever it's like down 50% from some kind of midpoint, it's a good buy. The same goes for Kinnevik or JM Big. They have fallen by 80% or more like 5 times over the last 40 years, and then they always roar back to life with a couple of 100% upturn, because they have a given place in the economy. They are so enmeshed, and they have their contacts, they have their financing, everything is in place, and then they get caught up in hype and despondency waves, but then they always get back. It's the same thing with the 4 big banks. They have a certain given amount of Swedish economy, and they will keep that.
The other question, you talk about owning private equity, right?
Mm-hmm.
Okay. Are you buying into private equity because you expect the company to fight for
IPO
to go public in the future? Is that why you are buying?
Not explicitly. The reason I started investing in startups and private equity at all was simply that some friend started with a company that he wondered if I wanted to invest in. Once I started doing that, I was hooked, so I never really had a plan. But in the end, right now, for example, I've got like 3 possible liquidity events coming up, like either sales to some industry partner or a bigger company, or IPOs. And then I realized that that probably was what I was aiming for all the time. But on the other hand, in at least one of the investments, Polskenet, which is an investment company, it doesn't really matter to me if they go to the stock market or not. I was just looking forward to getting the dividends. On the other hand, if they do go public, then it gives me a much more direct way of getting hold of the money if I wanted to sell the stocks. But that's not really what I'm after. I'm after like income rather.
You never own a company, a private equity that goes public. No. In a way, one company got acquired by a public company at 70 times what I invested. 70.
I'll try to keep it short, but I work in a bank, and during Brexit or COVID crash, people were running to the bank and sell my positions. Then my work was more to teach patience, because I said, when we met first time, you said 20 plus years. Why you want to sell today? It's just been 6 months. So when in life you learn that patience is a key to success, and how did you sort of learn it?
I didn't put it into words until after quitting from Futuris. So it was when I wrote the book in 2015 that I realized that there's a recurring theme here of patience. That's always what creates returns and anything of value. So it took until really after my career to realize that. But I did have patience, like naturally, and that came from learning to code by myself as a 10-year-old. All the literature and the computer in itself, everything was in English, and this was in 1982. And I stayed up all night just writing programs, debugging, and that meant that I had to have patience. There was nobody to ask. There was no online. I couldn't go to the library. I mean, what could they have on computers? At least anything that was relevant to me. So it was me and the code. I think that's where the groundwork of patience was laid. Yeah. The time is. I think my time slot is about to run out. Or do we have a time for some questions? Or I think. Well, was there anybody? You were in the waiting.
Maybe 2 or 3 questions.
Mm-hmm.
I will put 2 questions in 1 question. So you didn't. So you joined the Futuris, right?
Mm-hmm.
Okay. So when it was founded, how much money did it raise? And my second question is there a limit to how many clients a hedge fund can have?
There's no limit to how many clients you can have, at least in Sweden. There are certain regulations in the US where you have to stay within a limited number. because otherwise you're considered more public, and then you have to abide by other rules. Futuris was incepted in October 1999, and I started there in February 2000. And they started with 20 million euros, just 200 million kroner. And that was definitely subscale. So the fund actually, we almost wound it up after the first year. Had to. Well, one of the founding partners, he actually quit the fund because he couldn't afford being a hedge fund manager. So he had to go back to being a broker. We struggled quite well. Luckily, we made about 100% returns the first 3 months, or 60% after fees. So that at least doubled the portfolio. And then we did get some inflows. So pretty soon we were up to like 100 to 200 million euros. So that was enough scale to actually be profitable. I think the founding partners, they didn't really think in terms of like we have to have a certain scale or we have to make a lot of money. We just want to do this because it's right. We can't just keep being on the sell side and like siphoning money off of our clients. We have to actually create some value ourselves. Looking back at it now, I can hardly understand how I could be so both reckless and adventurous to just throw my sell-side career in the trash bin and join a small subscale startup hedge fund without really even knowing what a hedge fund is. So it goes to say that I've managed to stay naive throughout my career. It's just until right after it all that I am trying to started to actually understand how the business works and see what it was that I actually did. So I did stuff and I did them right and with a very positive result. But I didn't have the meta understanding of myself until afterwards, that I actually could just slowly and carefully analyze what was it that I actually did that worked. Had I done it earlier, then maybe I could have countered that hubris cycle or made even better returns. Probably I would have been better at stop losses, I think, as well, because that's always been my worst area. Because I think I am correct. I'm right. All right. Yeah, I think that's enough. Maybe we can always ask me more questions later if we have the time.
Maybe I can ask the last question of curiosity. Can you tell us, before you retire, when you make the decision to retire, can you tell us how much money have you made in order to make such kind of decisions? I know the amount, but maybe I would like.
I am on record on some interviews from right after I quit, and then didn't really think about what it might mean to spread information about my wealth. But I had made about 100 million kroner when I was 41, 42. So I figured that would be enough to get me at least to the age of 65, and then I could live off the state. And it seems to be enough still. And I got a little bit more now than I had done, but and we'll see with a few of the upcoming IPOs. Could easily be twice that.
I saw you have a course. There was a course. How is it? Is it free or is it still?
No, it's we're actually launching today. I think my partner is hitting the send button to take on paying clients. It's not for free. I could of course create some kind of a discount for the participants in this room if you were interested. It's pretty expensive. It's like $690 for the basic package. It's a 6-week course. If you take the English one, it gives you lifetime access to all updates and of course access to me and the private forum. But it's really like either you really know that I want to understand this in detail, and then like $700 is nothing compared to what you might win or lose on your portfolio. But otherwise, I definitely understand that it's not, for most people, it's not an interesting prospect to spend $700 on an online course.
you were in our shoes, would you choose that subscription?
Yes, I would, definitely. I mean, it's a shortcut to actually getting a systematic overview of what it means to find stocks, to analyze them, to invest, to manage and optimize a portfolio, to actually know how to assess a press release, how to read an annual report effectively, how to actually model various scenarios for growth and profitability. Once you have it all laid down in that systematic way, then you can add your own flavor to it and adapt it a little bit. But I think I wish somebody had given that kind of overview to me when I was at Stockholm School of Economics or in my first job, because it would have saved me so much time and effort.
Thank you very much.
Thank you. Thank you.
So, I asked the university.